Welcome to this week's edition of Macro and Flows from Orestes Capital for the week ending on May 29th, 2026. We're Elena and Marcus.
We want to start by looking at a profound structural disconnect we are seeing between market momentum and, well, actual economic reality.
Right. I mean, if you imagine flying a commercial jet through heavy fog, you check your altimeter and it shows you are steadily climbing.
And everything in the cockpit feels entirely smooth.
Exactly. The only problem is you have completely turned off the forward radar. You have absolutely no idea there's a mountain directly in your flight path.
Which is exactly where our internal data says the current market is sitting right now. To understand how we arrived at this disconnect, you really have to look past the daily barrage of financial media.
Yeah, there is just an immense amount of noise right now. You have conflicting geopolitical signals, constantly shifting central bank rhetoric, unpredictable earnings prints.
And we do not rely on that narrative. To navigate this environment, we strictly utilize the OCM-PCA model.
We should probably break down the mechanics of the PCA, or principal component analysis, for the listener. It is the absolute foundation of how we are positioning capital right now.
Yes, definitely.
So think of the PCA model as a pair of industrial-grade noise-canceling headphones for your portfolio. If you are standing on a busy trading floor, you are hit with a chaotic blend of shouting and volatile price ticks. That is the daily financial news cycle.
Right.
The PCA algorithm mathematically filters out all of that transient high-frequency noise. It analyzes thousands of disparate data points to isolate the low-frequency hum, the primary structural engines that are actually driving asset prices beneath the surface.
And when we put those noise-canceling headphones on this week, the signal we receive is unambiguous. The market remains firmly anchored in a euphoria or reflation regime.
Our primary factor, PC1, which measures global growth pricing, currently sits at an extreme 92.6th percentile.
To put that in perspective for your portfolio, capital is heavily concentrated in assets that mathematically require aggressive, uninterrupted economic expansion just to justify their current valuations.
And that 92.6th percentile reading is exactly where our proprietary modeling starkly diverges from the consensus across the street.
Entirely. If you look at the prevailing narrative right now, there's a distinctly celebratory tone out there.
While the S&P 500 just recorded its 9th straight week of gains, it posted a full 5% return in May alone.
Right, and the consensus is treating this price action as a pure fundamental victory, operating under the assumption that the underlying economy is flawless.
But when you evaluate the actual factor trends, you uncover a critical structural vulnerability. The absolute momentum of this reflationary pricing is actively plateauing.
The upward velocity has dropped from its mid-month peak, even as the headline indices push higher. The market is experiencing severe internal crowding as a result.
We see that crowding very clearly in the data. Emerging markets, tracked via the MSCI EM index, and industrial metals like copper are statistically overstretched right now.
They are the highest absolute positive contributors to our growth factor. The spread between cyclical stocks and defensive stocks is sitting at extreme statistical tails.
Which brings up a vital point regarding the nature of this specific regime. I mean, when we use the term euphoria, the natural assumption is that it implies an imminent catastrophic crash. Is that what we are looking at?
Not necessarily an immediate crash.
I look at the current market structure more like a heavy-duty rubber band. We know it is stretched to a 92.6th percentile extreme.
Right.
So the critical question for the listener is the market a rubber band that is fundamentally frayed and about to snap tomorrow? Or is it simply pulled, taut, fully capable of holding that maximum tension for a long time?
Well, from a purely mechanical standpoint, a rubber band pulled to that extreme percentile requires constant, massive physical force to remain taut.
Translating that to financial terms, extreme cyclical stretching requires continuous, aggressive capital inflows.
Exactly. If those inflows simply stabilize, let alone reverse the tension releases, and asset prices reprice violently downward.
So the structure of this regime demands that we examine exactly who is currently supplying that capital. We have to deconstruct the flow of money.
We need to evaluate the two distinct forces currently moving the money right now: systematic traders and retail investors.
Let's start with the systematic side, specifically commodity trading advisors, or CTAs.
For context, CPAs operate essentially as emotionless, algorithmic trend followers. They do not read quarterly earnings reports, and they certainly do not factor in macroeconomic headlines.
They are pure mathematical engines programmed to execute based on price momentum. If an asset's trend is moving upward, their algorithms automatically instruct them to buy more.
And if the trend breaks downward, they automatically sell. They effectively put market momentum on autopilot.
Right now, CTA positioning is overwhelmingly long on global equities. Their algorithmic models are providing a relentless baseline bid across the S&P 500, the NASDAQ, and the KOSPI.
Furthermore, they are heavily long on rates. This systematic, programmatic behavior establishes the structural foundation of the current market rally.
So the machines are buying because the price is going up, and the price is going up because the machines are buying.
Precisely. But when we analyze market intelligence regarding retail investor flows, we see a completely different behavioral pattern layered directly on top of that systematic foundation.
Retail flow is not aggressively buying the broad indices. Instead, it is heavily concentrated in very specific thematic pockets.
We are tracking massive capital injections into the memory and artificial intelligence sectors. Stocks like MU and SK Hynix have just crossed the $1 trillion market cap threshold.
And that momentum is heavily supported by multi-standard deviation retail inflows. We are also tracking explosive retail activity in space exploration.
Yeah, there are massive call option volumes flooding into ASTS and NASA exchange-traded funds.
Additionally, quantum computing has emerged as a primary target for retail speculation.
That was spurred abruptly by a recent $2 billion government injection distributed across 9 specific companies.
These are highly speculative, high-beta thematic pockets. The sheer volume of capital moving into these narratives fundamentally alters the volatility profile of the underlying assets.
Looking at this dynamic, we have to ask a structural question about control. Are retail investors actually driving the bus in these specific tech sectors, or are they just surfing the massive liquidity wake left by the systematic CTA flows?
Think back to your commercial jet analogy. The CTAs are the automated autopilot system. They are maintaining the broad altitude and the overall direction of the market.
They provide the baseline liquidity.
Right. The retail investors are the passengers who have wandered into the cockpit and occasionally yank the steering wheel toward a specific, shiny object on the horizon like quantum computing or space ETFs.
That is a perfect way to look at it. The CTAs provide the structural floor, but retail flows that dictate the localized volatility and the extreme valuation multiples in those targeted thematic pockets.
Both the computer algorithms and the individual retail investors are aggressively buying the momentum narrative. However, our internal models indicate that this buying behavior is completely disconnected from standard economic fundamentals.
That disconnect is clearly illustrated when we review the broader macro and policy backdrop. Let's look at the OCM model's PC3 factor, which tracks economic surprises.
Currently, PC3 is registering as statistically neutral.
To understand what that neutrality actually means for your portfolio, the massive rally we are witnessing in risk assets is completely decoupled from incoming economic data.
It simply does not matter if inflation prints slightly hot or if employment data comes in soft. The market is entirely indifferent to the macro reality.
The rally is relying purely on price action and structural momentum. We are also observing a clear softening in the rates and reflation momentum.
The PC2 factor has stepped down significantly over the last 3 weeks.
Yet when we analyze the 13-week cumulative flow, overall positioning remains structurally skewed toward rising rates.
So the market is heavily positioned for higher yields, even as the momentum of that core reflationary narrative loses velocity. We are seeing this disconnect at the specific sector level as well.
Look at the transport sector. It recently received a massive capital boost following the Montgomery Supreme Court ruling.
Money flooded directly into trucking and logistics names. However, this happened despite serious, unresolved debates among economists regarding the actual supply-side tightness that ruling will ultimately generate.
The market bought the headline immediately, completely ignoring the complex economic reality of how that ruling will be implemented.
If the PC3 economic surprise factor is neutral and the market is ignoring fundamental data, the entire structure is in a precarious position.
Returning to the aviation analogy, the market is currently flying that massive aircraft through heavy fog. The pilot is looking exclusively at the altimeter, the upward price action, and confirming they are climbing.
But they have completely disabled the forward radar, the actual economic data. You can fly blind using only upward momentum for a certain period, but you cannot do it indefinitely without hitting a mountain.
Exactly.
So the critical question becomes, how long can the market safely sustain this altitude before the reality of the macro environment forces a correction?
Well, flying blind on pure momentum is precisely the mechanism that creates deep structural vulnerabilities beneath the surface of the market.
When investors collectively ignore the radar, they rely entirely on the mechanical integrity of the aircraft to keep them aloft.
To understand the immediate tail risks, we must look directly at the market's internal mechanics, specifically focusing on the options market and dealer positioning.
This requires demystifying market plumbing and the concept of dealer gamma. We will bypass the abstract derivative mathematics and focus strictly on the practical mechanics of how this impacts asset prices.
Market makers are essentially Wall Street's middlemen. Their primary mandate is to stay perfectly delta neutral.
This means they do not want to carry directional risk. They are in the business of collecting premiums and bid-ask spreads, not betting on whether the market goes up or down.
When retail and institutional clients buy massive amounts of call options, which are highly leveraged bets that the market will continue to go up, these dealers are the ones taking the other side of that trade.
Right, and to hedge their own directional risk and remain politically balanced, the dealers are mathematically forced to buy the underlying stock.
In normal, healthy market conditions, these dealers act as shock absorbers. If the market drops, their mathematical models dictate that they buy. If the market spikes, they sell.
This naturally smooths out volatility and provides liquidity. However, in the current euphoria regime, characterized by explosive historic call option volumes in tech and consumer cyclicals, the dealers have transitioned from shock absorbers into amplifiers.
Because they're carrying massive short option positions against the public's long calls, their hedging dynamic inverts. As the market grinds higher, they are mechanically forced to buy more and more of the underlying stock, just to maintain their neutral hedges.
This forced buying artificially accelerates the upward price movement.
Conversely, if the momentum were to suddenly stall or drop, they would be forced to aggressively sell those hedges into a falling market, severely exacerbating the downward velocity.
We are already observing historic stress on the market's plumbing right beneath the surface. Consider the TMT momentum pair. It recently dropped 1,020 basis points in a single day.
That is a massive, violent volatility event occurring entirely under the hood of the market. It is largely hidden from investors who only check the headline level of the S&P 500 index.
But it clearly indicates the fragility of the current hedging structure. Furthermore, this underlying plumbing stress is being actively compounded this week by the largest MSCI quarterly rebalance on record.
We are tracking an estimated $118.4 billion in two-way flow executing across developed markets.
When you combine the forced buying or selling of option dealers with a $118.4 billion mechanical rebalancing event, the market's foundation becomes highly unstable.
For your portfolio, this plumbing setup completely changes the risk profile.
The options market has fundamentally become the tail wagging the dog. The derivative bets are now so massive, and the dealer's required hedging is so large that the options market is actually dictating the price of the underlying multi-trillion-dollar companies.
When the tail is wagging the dog, and the middlemen are positioned in a way that will amplify any directional reversal, the structural setup for a sharp correction is fully primed.
This brings us directly to the tactical implications and what the OCM model defines as the current pain trade.
The pain trade is the specific market outcome that will inflict the maximum financial damage on consensus positioning. Right now, the pain trade is holding unhedged risk in hypercyclical assets during this mature stage of the euphoria state.
The consensus across the street is entirely ignoring the structural fragility we just detailed.
Our proprietary modeling utilizes historical base rates for this exact mathematical setup. The models project a severe, programmatically driven jump in overall volatility.
Specifically, the model anticipates the VIX expanding by positive 9.03 points. Simultaneously, it projects the MV index, which tracks bond market volatility, spiking by positive 8.46 points.
A volatility expansion of that magnitude requires immediate, proactive defensive positioning. We have a clear, actionable playbook for you based on these factor signals.
Step 1. You must rotate up in quality immediately. That means deliberately overweighting developed markets and large-cap equities.
Conversely, you must strictly avoid small caps and emerging markets. Our data consistently shows that these lower quality tiers suffer a highly asymmetric, violent reversal during this specific regime shift.
You want to avoid lower tier credit entirely. Anything sitting in the CCC or BAA tranches is highly vulnerable here.
Step 2 involves your fixed income allocation. You must maintain a strict flattener bias.
The model projects the 2-year to 10-year slope is set to compress rapidly, so your duration positioning must reflect that specific yield curve dynamic.
Step 3 is the most critical risk management mandate for this environment. You must buy volatility protection right now while the consensus is still complacent.
With the VIX and the MOVE indexes mathematically programmed to spike, utilizing equity tail risk hedges and fixed income call options is absolutely essential.
You cannot simply hold cash and wait it out. You must actively hedge against the downward velocity that the dealer gamma profile is structurally guaranteed to create.
To summarize the tactical reality of this environment, the broader market crowd is currently standing at the very edge of the ship, leaning far over the cyclical rail.
They are completely mesmerized by the upward momentum of tech and memory stocks, ignoring the macro radar.
The smart money, guided by these internal factor signals, is quietly stepping back. They are moving to the center of the boat by rotating up into high-quality assets.
And they are actively strapping on a life jacket by purchasing targeted volatility hedges.
Before we conclude, there is one final structural consideration you need to evaluate for your portfolio. Our modeling currently identifies energy as the highest conviction asset within this specific regime.
Conversely, gold remains mathematically depressed, acting primarily as a funding short for other positions right now.
If the euphoria volatility trap springs exactly as our base rates project, and the options market mechanically amplifies the downward reversal, you must ask yourself a critical question regarding your asset allocation.
When paper assets abruptly reprice to reflect economic reality and market liquidity instantly vanishes due to dealer positioning, which of these hard assets will act as the ultimate liquidity sponge to stabilize your portfolio?
See you next week, wherever the flows take us.